tariffs impairing trade and rising geopolitical risks are putting pressure on global as well as euro area economy and thus responses of economic policies, we are fortunate to have with us a remarkable leader whose insights and expertise have been has made a significant impact in shaping the current policies of the ECB. While growth has been modest, the euro area economy has shown to be resilient in recent years when faced with challenging global environment. Despite that, we expect a slowdown in the economic activity this year, but steady and gradual recovery in the following years. With respect to the inflation, our task of keeping inflation in place was extraordinarily challenging in recent years. Nevertheless, ECB's monetary policy was, and still is, very proactive in every sense of the way in maintaining inflation at its target. Recent data confirms our efforts, as the headline inflation in the euro area had been hovering around the target for several months now. Even more, I firmly believe that in the absence of new economic shocks, the interest rate level set by the ECB is appropriate for the continued maintenance of the inflation at target. This means that conducting our monetary policy neither fuels inflationary pressures on one hand, nor is restrictive to economic activity on the other, which would mean sustained deviation of inflation below our target. This brings us to the work of our distinguished guest. Mr. Philip Lane has demonstrated outstanding dedication and innovation in studying international economics and economic growth. Throughout his career, he has been driving force behind relevant research hot topics and shaping the direction of economic policy in Central Bank of Ireland and later on at the euro area level at the ECB. His work has not only earned national and international recognition, but has also inspired countless professionals as well as students. Please join me in warmly welcoming Mr. Philip Lane, member of the ECB's Executive Board, who will share with us invaluable perspectives on the latest developments in the euro area and on global economy. Thank you.
So let me thank Primož for the very nice introduction. Let me thank the organizers of the conference for the invitation to take part. Exchange rate economics was, essential to my academic career. And of course, it's very much a topic that the ECB pays a lot of attention to. But just as Primož outlined some of the inflation challenges facing the ECB, I've actually divided the presentation into two parts. The first part will be about what's on the screen, inflation deviations and monetary policy. But then in the second part, I will do a gear shift towards the exchange rate topic. So it's, maybe with that diversified agenda, the people in the room, some of you might be interested in the first part, some in the second part, and of course, if you walk out after the first part, I won't be offended. So there's a very natural reason, I think, to take on this topic, and Primož already alluded to it with the phrasing, that this has been an important topic in recent times in terms of thinking about how monetary policy should respond to deviations from 2%. As I developed the argument, monetary policy is straightforward when inflation is 10 or 0. Very far away from target, you have to do something. But when you're around a target, under what circumstances do you respond to a deviation? And under what circumstances do you look through and say, monetary policy does not need to respond to that? And so I want to develop a way of thinking about that question. And as I say, after that, I will get to the exchange rate topic. So maybe just as a reminder, the starting point, of course, is what is the ECB's commitment? The ECB's commitment is 2% inflation in the medium term, and that is a symmetric commitment. If we see a deviation, positive or negative, that is equally costly. That is a relatively new commitment. It was made in 2021, because for most of the history of the ECB, in fact, it was an asymmetric commitment. The commitment was close to 2%, but below. And so when you make a transition from one commitment to another commitment, clearly sometimes that raises questions about how deeply embedded is that symmetric commitment to 2%. But I mean, I think I'm going to stipulate we do have a symmetric commitment, we really mean it. But let me focus on the other part of that commitment, which is over the medium term. So clearly, we're not going to say we're going to deliver inflation at 2% every month. Shocks happen with lags in the transmission of monetary policy. A very basic reason is if something happens so that the inflation rises or falls, and it's not expected to persist for any length of time, we have to accept that kind of fluctuation. And that's why the medium term makes a lot of sense. And then, as I said, at the other extreme, if you have a very large and persistent deviation, it's clear monetary policy has to respond, no contest. So what I want to focus on is an intermediate category. So not so small and transitory you can ignore it, not so large and persistent that it's immediately obvious you have to respond. And that intermediate category is really, I suppose, where we are. And that's where we should expect to be. It should be exceptional, the 1970s, the pandemic. It should be exceptional that we get a really high inflation number or a very low inflation number coming out of a financial crisis. Most of the time, monetary policy is responding to local shocks. It moves you away from 2%, and then you have to think about how to respond. So the question is, why should you respond? Again, if it's something that's not too far away from 2. And let me give you 5 reasons. 1, there's a cost of living channel. So the inflation rate today influences essentially wage negotiations next year, let's say. So if inflation's at 4 or 3, that will influence what workers need if they're targeting a given real wage. We've seen that for the last 5 years. The high inflation in 21-22 drove wage negotiations in recent years. Equally, if inflation's 0 or 0.5, workers will tend to settle for fairly low nominal wage increases. So what I just said to you is the second round. If there's an inflation deviation in the first round, the second round adjustment will tend to move in the same direction because of that cost of living channel. A second factor that moves inflation in the same direction is the real interest rate channel. So if you have inflation that is low and is expected to persist, let's say, for a year or 2, for a given nominal interest rate, of course, that means the real interest rate is relatively high. And depending on how powerful that real interest rate channel is, that's going to lower demand in the economy and therefore add to disinflationary pressure. Third is depending on your attitude to how people form inflation expectations, there's a lot of the behavioral economics literature puts some weight on extrapolation. You look at today's inflation number and you extrapolate. So if inflation is low today, you might put some weight on inflation remaining low tomorrow. And if inflation is high today, put some weight on inflation remaining high tomorrow. That's true to some extent. That the balancing act is, even in the high inflation episode, people were confident inflation would get back to 2% in 3 years and 5 years. So this is more about maybe a 1-year shock turning into a 2-year shock or a 3-year shock. A fourth channel is a communication channel. So it's consensual in economics that we want people to understand our reaction function. They want, a lot of monetary policy works via people working out if inflation goes by X, monetary policy responds by Y. So Ben Bernanke had this famous quote, monetary policy is 99% talk, 1% action. If people understand the reaction function, then the market adjusts, and that basically makes monetary policy a lot smoother. So here the question is, if you don't respond, how do people learn about your reaction function if there's no reaction? So, and that does create some uncertainty. It creates uncertainty about, do they really mean that they have a symmetric 2% target, for example, if we don't respond? So those four channels, I think I said 5, it's actually 4, so I've saved you one. So all of those channels mean there is a reason to react. Having said that, all of those channels, I think, look fairly nonlinear. They both look nonlinear one by one, and they probably look nonlinear in combination, which means, again, clearly for large deviations, all of those will mean you have to respond. For intermediate-sized deviations, then it remains a judgment call. So how do you make that judgment call when you have an intermediate-sized deviation? What I would say is if the deviation is broad-based, it's core, it's energy, it's food, it's everywhere. That's the standard textbook example. It's general inflation away from target. There's going to be some number at which you do respond. And that's basically in every monetary policy model in a textbook, the Taylor rule and so on. You get a local shock to inflation, you do an interest rate response. And with the Taylor principle, the interest rate response is more than 1-for-1 to the inflation deviation. Again, the mapping to the real world from that very basic insight, it remains a challenge. So let me differentiate that versus another type of inflation deviation, which comes from a relative price shock. And the most obvious one to think about is an energy price shock. And in the recent data, what we have is, right now, non-energy inflation is around 2.5. Energy inflation has been for a long time negative. So the overall inflation rate is a mix of, right now, inflation that is core inflation, non-energy inflation that's still above target, offset by very low energy inflation, in fact negative. In the September projections, what we have next year is non-energy inflation at target, but overall inflation noticeably below target because energy inflation is still projected to be negative next year. So that is a different type of inflation to a generalized demand shock that raises prices across the economy. And there's a number of reasons to think all of this, our target is headline, but in terms of thinking about the kind of risks to the medium term, I think there's a clear difference there for several reasons. One is that if the energy shock is big, as in the Russia-Ukraine example, other sectors of the economy have to raise their prices. Energy-using sectors, transportation, hotels, food, lots of sectors use energy. If the cost shock is big enough, they will raise their price. However, for intermediate-sized shocks, I think the history of the euro area is quite often its profit margins absorb it. Firms do not necessarily pass on the full scale of the energy shock to their customers. So that basic issue, will this sectoral shock pass along to overall inflation, is an open question for these intermediate-sized shocks. A second element is if it's a supply-driven relative price shock, it tends to have a self-correcting element. So if you think about a decline in the relative price of energy, that means it should boost, by reducing costs, there should be an expansion in energy-using sectors. And that expansion in the economy will tend to raise inflation over time. So the original negative price shock generates price increasing dynamics over time. For energy in a European context is an extra fact, which is it's because we import so much energy, it's a terms of trade shock. And so if the price of energy falls, it's a terms of trade improvement for the euro area. It increases real incomes in Europe, and again, that will tend to raise demand over time. So what I would say is in thinking about when to respond to deviation, when to not, and again, I'm using terms like intermediate level. I'm not giving you what exactly that number is. For these intermediate level shocks, it requires a careful analysis, not just of headline inflation, but understanding supplementary measures such as non-energy inflation and core inflation. And I think in order to make a decision on that, it's best made meeting by meeting. It's best made on a rigorous analytical framework. And I'm sure the staff here at all the central banks represented and at the ECB, we spend so much time, taking apart the overall inflation number to try and detect whether relative price movements are converting into overall inflation or not. So what I've tried to convey here is that it's a non-obvious monetary policy challenge. It's case by case, it's context specific, and this is essentially what we will be dealing with when we see deviations from inflation along the projection horizon. And maybe the last thing I'll say on this first part is, of course, all of this is only possible if you have a credible commitment to your target that anchors expectations. We have that at the ECB. I think we've shown that. But that is essentially, it's important to say that, because of course, if we lost that anchor, if we lost that credibility, which many emerging markets have had to do, no matter where the inflation is coming from, they have to respond because inflation expectations are more fragile than they are here. Okay, so that's my my inflation and monetary policy section. Let me now turn to the topic of the workshop, which is exchange rate analysis. So what I'm going to do is run through how different analytical tools at the ECB think about exchange rates. And maybe before I get to that, maybe I'll just do a little bit of description. So this is the history of the euro area. Of course, you can look at other currencies. You can get 1,000 years of data on, sterling and so on. But I'll be short run here and just look at the last 26 years. And maybe there's a couple of things to say here. Is number one, there's no trend here. We index here to 100 at the start of the euro. Whether you look at the real or the nominal, it's around 100 now. So very large fluctuations in the exchange rate. You can see here the first 18 months of the euro, a big depreciation. Then you look there from like 01 through 08, a pretty big appreciation. Then another depreciation phase through early 2015. And then from early 2015 onwards, until this year, it's been fluctuating in a very narrow range. And I'll come to this year in a minute. So this, of course, means that there are big medium-term effects on inflation and the economy, which, of course, matters for monetary policy. So let me zoom in over the last 10 years and look at some key exchange rates. So on the left side, it's the euro-dollar. This is important, not just because the US is an important trading partner, not just because the dollar is important in the world financial system. But of course, many activities around the world are invoiced in dollars. So it's an important vehicle currency. So it has an outsized impact on the overall global system. And so let me draw your attention in this graph to two factors. One is a historical reminder that from early 2014 to early 2015, there was a really big euro-dollar movement from nearly 140 to 110. This, of course, was the period when the ECB changed gears. They introduced negative interest rates. They talked about and eventually did quantitative easing. And at the same time, in the US, monetary policy was starting to tighten. So there's a big step change in the exchange rate in 2014, 2015, which is really is outsized compared to what's happened since then. So from mid-2015 to now, more or less, no trend. But you also see in the last year a significant appreciation. Let me now turn to China in the middle. And again, with China, that time period, early 2015, was interesting from both sides. So a lot going on in the euro area, but then in summer 2015, a lot going on in China. There's a big, stock market reversal. There's a change in their currency policy and so on. So you had a lot of action at that point. But again, until mid-22, there was a cycle. You can see there was an appreciation and then depreciation, of this bilateral exchange rate. But what's interesting is from summer 22 onwards, there's been a trend appreciation. What happened in summer 22? We started hiking interest rates. And even though we've reversed that, we've only half reversed it. The interest rate now is settling around 2%, whereas before the pandemic, the market was highly convinced that the policy rate was not very likely to go much above zero in the indefinite future. What you see also in the middle is the real appreciation has been a lot bigger than the nominal. China has not had the CPI inflation we have had. In fact, CPI inflation has been very low in China. So when we think about the competitiveness of Europe versus China, it's a mix of the nominal exchange rate and then the very big cumulative inflation differential. And then the last chart expands the analysis to include Japan, Korea, Indonesia, and so on. Because of course, Asia is a very big trading region. It's not just China. And on top of the appreciation against China, there's been a big appreciation across all of those countries. So when you think about the reconfiguration of the world economy, once you zoom in to this period, it's significant. So then the question is, okay, how do we think about that? So what I want to turn to are some of the analytical tools at the ECB. Well, so one analytical tool, and this is about the euro dollar, is we have a kind of running empirical model, a vector autoregression, a Bayesian vector autoregression, a BVAR, which tries to allocate fluctuations in the euro dollar rate to different driving forces. I'm not going to get into the details here, except to highlight the orange, if that's orange. I'm not very good at colors. The orange box in Q2 25. So part of the significant appreciation of the euro against the dollar in spring 25 and Q2, April, May, June, is a risk sentiment shock. Now, this model is a differential model, US versus Europe, and that risk sentiment shock is a downward revision of risk attitudes to the US, an upward revision of risk attitudes to Europe. And that is significant. Another way of saying this is there are macro consequences from, if you like, portfolio rebalancing dynamics, from changes in investor attitudes. So I know I got sent all of the papers and slide decks from the workshop, and there's a lot of papers, related papers, about trying to understand risk and exchange rates. But this is a really concrete example. If you go back over the history of this decomposition, there's not too many quarters where risk played such a big role. Okay, so we try and understand where the currency movements are coming from, but then we also want to understand what is the impact on the economy. So in order to do that, of course, every episode is different. You really have to understand, does a risk-driven currency appreciation look different to a monetary policy-driven appreciation and so on? But actually, for many purposes, it's analytically helpful to take a generic exchange rate shock. So just having some exogenous, imposed exogenous shock that generates a currency movement. And so what I want to do is show you what it looks like in our workhorse model, the multi-country model. And in the note to the chart, and all of these charts are on the ECB website, it is actually just in September, I think, we released a super detailed working paper showing you a lot of the engineering behind this model, which is centrally used in the Euro system. And so if you take a 10% appreciation, what you see here is, and this is 12 quarters, it's 3 years on the horizontal axis. Compared to our 2% inflation target, these are not small deviations. So we have in year 1, 0.3, 0.4. At the peak, after about 4 quarters, it's 0.6. 0.6 is an interesting size of number in our world where inflation target around 2. If our inflation target was 20, 0.6 wouldn't look so big. But inflation target of 2, 0.6 is significant. And even in year 3, it's still 0.3. This is inflation rate. So it's kind of accumulating into quite a big price level effect. The other elements are levels. So what it shows is over these 12 quarters, it exerts continuous downward pressure on GDP. So the 10% appreciation leads to a cumulative 1% drop in GDP, again, compared to baseline. That's not small. Remember, European economy is going around low ones. So 1%, cumulative is not small. And behind that, a lot of this model works through trade mechanisms. And what you see here, which is a lot of it is on the exporting side. So exports fall by about 3% cumulatively, about half that for imports. And again, if you read the very detailed paper, you can get some more insight. This is a macro model. Famously, our macro models are not so strong in financial channels. So it's also useful to be a bit empirical about it and ask, do exchange rates also affect financial conditions in the euro area? So financial conditions are a very robust predictor of inflation and activity. There's a whole world out there of FCIs, financial condition indices, which do a very good explanatory power. So if you tighten financial conditions, you see a drop in inflation, a drop in activity. If you loosen, a rise in inflation, a rise in activity. So at the ECB, they developed a new FCI. One of the variables is the exchange rate. So let me show you its impact on financial conditions according to this model. So the baseline model brings the exchange rate in as a nominal effective exchange rate. So that's the first column here. And what you see here is an appreciation tightens financial conditions. This is reduced form, so how much of this is operating through financial channels, how much is operating through trade channels, this will not tell you that. But what's interesting is in this kind of series-free type financial conditions index machine, it's purely empirical. It says it does weigh down in the European economy. That's consistent with the macro model, but it allows for other channels, especially financial channels. So maybe what's even more interesting is they said, okay, well, let's see if all exchange rates are the same. So then rather than putting the nominal effective exchange rate, you do some bilaterals. You put in the euro dollar, euro, yuan, sterling, and so on. And what's very interesting here is you get a different answer for euro dollar and to some extent euro sterling compared to what you get for the China and the Swiss franc. To me, what this is saying is essentially, and again, it is a black box to some extent, so it's more of a interesting empirical pattern that someone in the room who's an exchange rate economist can solve, is that the tightening is coming from the euro dollar. That makes sense given the dollar is so big in the financial system, whereas maybe the role of Chinese imports and intermediates in production mean appreciation against the RMB is actually loosening conditions, not tightening conditions. And same for the Swiss franc, and I think maybe it connects to the safe haven role of the Swiss franc. I did see in the program today we have several Swiss papers, and so that element might be interesting. Okay, so what I've said is when we start to ask, does the exchange rate matter for output and inflation? Yes. Does it matter for financial conditions? Yes. And so maybe the last thing I want to look at is, and let me just again say, here's a gear shift to the other direction, which is one reason why exchange rates move is monetary policy. So it's also important to do the other side of the analysis is, so far I've more or less treated the exchange rate as some exogenous factor reflecting external events. Of course, that's true a lot of the time, but the exchange rate also responds to monetary policy. We saw that in the 2014-2015 episode, where the kind of structural loosening of ECB monetary policy clearly had a role in the depreciation at that time. So what I want to do is show you how monetary policy affects inflation and output in some of our macro models. And here I'm showing three models. One is the ECB base, which is a semi-structural model, which again is a workhorse model at the ECB. But it's semi-structural, not everything is optimizing and so on. Whereas the new area-wide model is a DSG optimizing model. So those are two kind of important macro models. But we've added a third model to this, which reflects new work at the ECB. It's not the catchiest acronym ever, but it reflects the people as the author's surnames, GMGS. It's not so easy to say it's base, but GMGS is essentially a global model which brings in a lot of input-output networks and so on. So again, I'll let you in your own time study in more detail the details. But what you see here is if you have a surprise monetary expansion, so you cut the interest rate by 1 percentage point here, you see across these models, you do get depreciation, you do get an inflation rate going up, you do get GDP going up, and a lot of this, as I said, is coming through exports. Responding quite a bit. So I think that's important. Another way of saying that is when we think about the impact of monetary policy, the exchange rate is playing an important role. You might say, okay, tell me more. And the other thing I can do here is switch off the exchange rate. So take these models and say, let's impose that the exchange rate does not respond. And this is the chart 7. And if you compare those two charts, basically you get a muted response. The output effect is smaller, the inflation effect is smaller. So that's another way of saying is in an open economy like the EU area, monetary policy is more powerful than in a closed economy version. Okay, so with that, you know, I've kind of really tried to kind of advertise some of the work that's done in the Euro system on these topics. I would say, you know, that this is just one of the many variables that we look at in thinking about monetary policy. And in the end, our decisions integrate this type of analysis with all the other types of the analysis that we do. But, you know, from the point of view of the people attending the conference, maybe to some interest in that. So with that, I don't know if there might be some time for Q&A, but I'll leave it to you. Okay.
Thank you, Mr. Lane, for this inspiring speech. So, as he mentioned, now is your turn. If you have any questions, please raise your hands, introduce yourself, and he will be glad to answer. No questions? Okay. So I think you were clear enough. It looks like. So, thank you very much. So okay, there is one question. Yeah, just please wait for a microphone.
Only take it.
So this type of question comes up in different dimensions. So of course, during the pandemic, we had a big disruption in global supply chains. And clearly, that is a very important episode. Then with the tariffs, if it turned out that tariffs were going to be more global, with everyone retaliating against each other and set at high levels, there may well have been a more dramatic reconfiguration of global supply chains. Then you have specific examples. For example, if there were an export restriction from China on rare earths. So, and then maybe I'll advertise. A year ago, the ECB put out an occasion paper last December, which kind of did a scenario analysis about fragmentation of the world economy. So I think, and then the paper here, the GMGS model, which is here. A lot of motivation for that model was to bring in shocks to supply chains. So they have, you know, input-output networks, you know, global input-output networks in there. And so maybe I'll make a few points here. One, there is a big question about the transferability of what happened in the pandemic. Because in the pandemic, it was a perfect storm. And when everyone was at home in 2020, there's a big expenditure shift towards goods from services. At exactly the same time as the ability of the world to produce and transport goods contracted. So if you have a decline in supply and a surge in demand, you're going to get price movements. In general, however, imagine with the rare earths situation, these are not available. There would also, I don't think there's going to be a surge in demand for goods that use rare earths at the same time. And in fact, those sectors which are very reliant on those inputs may actually contract demand. So stop investing, postpone production. So I would say in that situation, there could be a big effect on output, but maybe not so much inflation. And this is because it is in the account of our last meeting, there's this discussion of Leontief inputs. So Leontief inputs, you have to have them. There's no substitution. But by that very nature, if you cannot substitute away from them, a lot of the activity will be on output, not prices. And then more generally, and this is where the value of this GMGS paper is to look at the general equilibrium, to look at because by and large, if you have something that disrupts supply chains, it reduces the value of the firms operating in those supply chains. There's a negative wealth effect from the fall in production, and that demand effect doesn't necessarily obliterate any inflation effect from the supply shock, but it mutes it. And this is why we do need macro modelers who do general equilibrium, who do the full quantitative simulations.
Okay, it looks like now there is more questions.
On both sides of the room, so yeah, but it might be easier from here. So yeah, maybe the mic is coming.
Thanks so much, Lena Bonivar, Swiss National Bank. Thanks for sharing your thoughts. I want to come back to the first part of your talk when you discussed reasons why you might not want to respond to deviations of inflation from its target. And you mentioned, for example, sectoral shocks. And so I wonder if you could elaborate a bit more on that, talking about the supply and demand component of these deviations. And obviously there's a lot of uncertainty around identifying that. If those deviations are transitory and persistent, again, this is very difficult to assess ex ante. And also maybe, that sometimes kind of not responding might be consistent with a commitment you might have given in terms of forward guidance. Yeah, it'd just be interesting to hear a bit more thoughts on this topic from you.
So that's a nice set of questions. So let me start with the forward guidance issue, which is important. One thing we've worked hard at in recent years, but in fact, we'd already strategically concluded this before inflation rose. So in the 2021 review, we said forward guidance is valuable at the lower bound, but away from the lower bound, the dominant policy tool is the rate decision. So hand in hand with that is a determination to go meeting by meeting, no pre-commitment, and in terms of our collective communication, we definitely try not to offer an opinion about the future rate path. So, because you do want to have the flexibility to be really data dependent. So then, as you say, a lot of these ex ante you don't know, and this is why really it is an invitation for gradualism in monetary policy. It's an invitation to really every meeting say, okay, is there enough here to justify, or do we wait and see? But with 8 meetings a year, and as Primož said in the introduction, right now, we brought rates down to 2%. The economy is growing. The inflation risk is not one way. We've seen some upside surprises recently. So in other words, we did have a clear projection of because of low energy inflation, of inflation falling below target, especially in the opening months of next year. But in fact, some of the data since then have moved in the opposite direction. So those are some of the mitigants. But in the paper, I could have sat here and read all the footnotes here, but I was giving you the general impression in my talk. But in the text, I focus on supply. It's important to say supply-driven rather price shocks, because if you see the price of oil move, oftentimes in the world economy, if the price of oil falls, that's reflecting weakness in the world economy. And that weakness in the world economy over time can put downward pressure on the medium-term inflation trend. So in that case, you would not want to say, this is just a relative price movement, we ignore it. You would take it as an important signal of where global demand is going. On the other hand, you can sometimes clearly see, I mean, clearly with Russian gas and so on, you can clearly see supply shocks. And so with energy markets, we have energy specialists who really, both independently, but also by all the people out there, there's a rabbit hole out there of people who really follow the energy systems and can really tell you a lot. They became very popular in 21, 22, when people really wanted to understand energy dynamics and the contributions of supply and demand. So we would spend a lot of time exactly for that reason. So I think over here.
So thank you very much for the word. I'm Matthias Maletic from Banka Slovenije. I would have one question which you mentioned, but not directly, but indirectly, about the financial channel of the foreign exchange market. So I would ask you how important you think that channel is, like to be more particular, like risk premium channel of the foreign FX markets, and this nexus between bond markets, FX markets, where basically monetary policy is, of course, more active. So, and also this is a bit for the advertisements for the late sessions today in the workshop where we will discuss these topics. Thank you.
I appreciate that, and I was very impressed as you sent me all the, so when I was on the flight last night, I was looking at all the 20 files you sent me. But let me say, it is, part of this relates indeed to cross-border financial frictions, including UIP DVA. But part of it, I think, does operate through the domestic banking system. I had a speech a few weeks ago about the transmission of monetary policy, and the European financial system is a euro-denominated system, but there's a lot of dollars in there as well. So there's been recent papers. So Larry Cristiano has, and he presented this, I think, at the ECB Monetary Policy Conference, pointing out that it looks like quantitatively, a lot of the international transmission of monetary policy does go through the financial system. And there's a paper by Nakamura Steinson in the QGE this autumn, which QGE or JPE, one of those, with someone else, which again is pointing out, really it looks like it's through credit dynamics that exchange rate works. I mean, one thing which is, I think, straightforward but matters is the effect on the relative wealth of home and foreign investors. In turn, that can influence UIP premia deviations, but it influences, for example, FDI dynamics. If you go back earlier to what I did, the 1980s, people who studied the big yen movement against the dollar, a lot of it showed up as Japanese firms making acquisitions in the US, Japanese investors buying up, US real estate. So there's a lot of transmission via relative wealth. So I think this is early days, to be honest, in terms of integrating the exchange rate in full-scale financial system models. So I like the people who are looking at the cross-border element, UIP deviations, all of that. But I think more generally, there's a lot to be done there.
Okay, any more questions? Okay, here, gentleman on the left.
Thank you very much. I'm Gianluigi Mandrazzato from EFG Bank in Lugano. Two questions, if I may. One is more say, technical. With most of trade taking place in goods and CPI being geared on services, would your conclusion about appreciation of the real exchange rate change if instead of deflating it by CPI, that would be done with PPI? And the other question is, you rightly mentioned the distinction between temporary and permanent or longer-term shocks. Can you give us an idea of what is the interpretation of the ECB Governing Council about how long is a temporary and so on? Thank you.
Thank you for those questions. So on the second one, we came up with a very precise definition when inflation was high. We felt it was important that inflation returns to target in a timely manner. And if you think about what that means, I mean, most important, it means sufficiently quickly that people do not start to question the inflation anchor. They don't start to say, well, maybe the 3-year ahead inflation expectation should be 3, not 2, and so on. So, and that is empirical. So essentially, the bigger the shock, you do want to come back, so looking at the risk factors about stability of expectations, what's going on to the real economy and so on. So even though the inflation shock was to 10.6 at the peak 3 years ago, we didn't follow the Taylor principle and say, well, we need to raise the interest rate to 12 or 13, because there was a big supply element to it. In late 22, our 1-year ahead inflation forecast was around 3% for late 23. So now that we brought the interest rate to 4, essentially to deal with bringing the inflation rate from 3 to 2, whereas the first element should have calmed down. What we do essentially is we look at the, so here just for ease I did CPI, but we do GDP deflator, we do unit labor costs, we do producer price index. They will all show different measures, but in Europe, I mean, in any given year or quarter there may be differences, but there's been a big increase in wages in Europe in response to the increase in inflation, and that has pushed up the GDP deflator, and I'm sure in many sectors the PPI, but it depends what if you're trying to think about the competitiveness of some given firm in some given sector, I would use PPIs. But if you think about the whole economy, that's not a settled question about if you had to pick one indicator, what do you use? But in reality, we use a whole family of different deflators.
Okay, any more questions? Okay, here in the first row. Thank you.
Marko Pahor, Banka Slovenije. Maybe it's slightly provocative. So looking at this model, well, it clearly shows your models that exchange rate reacts to monetary policy and that this reaction makes it more powerful. Now, but obviously exchange rate affects competitiveness of the economy, and now there's this big debate in the European Union about how to make European Union more competitive. Now, in light of this debate, it was in the past that central banks had different targets, and maybe exchange rate was one of the targets in the past for some central banks, never for the ECB. But given this debate on competitiveness, should we keep more of an eye on the exchange rate? And if yes, should we make this public or just keep it in the boardroom?
So for small and medium-sized economies, that's a genuine debate. When you take a continental-sized economy, so here I focus on the exchange rate channel, but in the end, it's minor compared to the dominant channel, which is the domestic effective monetary policy. So I don't think we can kind of, make our lives complicated by kind of adding extra objectives to a single instrument. So I think, delivering 2% medium term, that's a pretty clear objective. We do look at side effects, but I think to zero in on the exchange rate within that is I think too much over engineering. So.
Okay. Any more questions? Okay. It looks like that's enough. Thank you very much, Mr. Lane. Thank you everybody for listening, and let's see each other in another event. Thank you. Bye.